Ladies and gentlemen, good day and welcome to the Q1 FY27 earnings conference call hosted by Max India Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rajiv Mehta, MD and CEO from Max India Limited. Thank you, and over to you, sir.
Thank you. Namaste, everybody. A very good morning to all of you. On behalf of Max India Limited, we extend a very warm welcome to all of you for the Q1 FY27 earnings call. Sincerely thank you for your continued support, your trust, your confidence, which keeps us encouraging to undertake this journey in a very fast evolving sector. Really appreciate your time for joining us today. And let me share a few updates. But before that, I have with me my colleague Ishan Khanna, who is the CEO for Antara Assisted Care Services, Ajay Agarwal, who is Deputy CEO, CFO, Antara Senior Living and Head of Investor Relations, Sandeep Pathak, who is the CFO for Max India and also the Legal Counsel for Max Group, Ankit, who is the CFO for Antara Assisted Care, and Abhishek Singh, who is part of our IR team, and Devraj from SGA, and Rahul as well, who are IR advisors. We uploaded the deck yesterday, so hopefully all of you have had a chance to go through it. I think if I start with what happened in the last quarter, it's been just execution. We've been focused on executing, and therefore you're able to see now green shoots in all parts of the business. Would like to inform you that after a long wait, we have now issued offer of possessions to all our 340 residents in Antara, Noida in the month of June 2026. This is something we have been waiting for. This is a very important milestone in Antara's journey. We'll be operationalizing the first community in NCR. While we have many learnings from Dehradun, this is going to be quite different for us as well. 340 units, 300 people moving in the next 30 to 45 days is going to be a vibrant and buzzing community. We raised a demand of about 169 crores with the offers of possession. 30 odd crores were collected within June, but the rest has now come, most of it in July and August. As on date, approximately 75% of total dues have been collected. The rest are becoming due now, and we should be able to collect them as well. We have started to already put the team together. There are some people we have seconded from Dehradun to make sure the learnings and the culture of Dehradun also permeates into Noida, and we'll be ready to welcome the residents in a few weeks from now. After that, the focus will now shift to saying that can we go ahead and get the approval for phase 2, which is where we realize most of our profits. Just to remind you, while the average prices at which we sold Noida was between 7,000 to 10,000, the last sale being 11,000 or so, the rates have moved significantly up, and they are in the range of 16,000, 18,000 plus. So hopefully when we launch phase 2, we should be able to realize the profits as well. We continue to focus on growth of other geographies. I know some of you will be waiting impatiently saying, why haven't we announced more growth? But we are in the last stages of diligence for a wonderful opportunity in Bangalore. It's about, about 300 odd units. It's in North Bangalore, 25 minutes from the airport in Devanhalli, overlooking the Nandi Hills at the back. Potential realization about 900 crores in terms of sales value. We've in the last stage of diligence now with the developer, so let's see how that goes. Also aggressively working on a beautiful opportunity in Dehradun. We have had a long waiting list. We don't have inventory to sell. We have found a small piece of land. It might be just less than 150 units, but given the sales price we are commanding, the sales value will be again 850 to 900 crores. So if you look at our 1.5 million square feet ambition, about 1800 crores of value, that we should be able to achieve with these two. But we are still working on some more geographies as well. But these two are very specific, so I thought I'll mention them to you. We're also in dialogue with people in Chennai, Chandigarh, and Lucknow. But as these two will help us meet the commitment for this year. And obviously, we'll provide disclosures and more details once we execute the definitive documents. The expansion in assisted care is exactly as per plan. The occupancy in 485 beds is gradually increasing and is giving us confidence to explore further expansion sometime later part of the year. AGZ is also growing steadily. Whatever teething issues we have faced with our D2C channel or marketplace is now behind us, and I will share some numbers with you as we go forward. The efforts are to make sure we are able to manage the inventory days given the current geopolitical situation. That is something that's come under pressure because of logistics costs and the ships not being available to bring the material from China. But that is something we are focusing on and deploying, capital very prudently. We are very clear in our focus in terms of scalability and achieving profitability and demonstrating path to profitability. And I will share some numbers as I go forward to substantiate what I'm saying. If you look at the consolidated numbers, the revenue grew. Q1 FY27 stood at 68.6 crores compared to 41.3 crores in Q1 FY26, representing a Y-on-Y growth of 66%. On a sequential basis, revenues marginally declined, primarily due to the lumpy, way the DM income comes to us. The EBITDA loss for Q1 FY27 stood at 25 crores compared to 23.2 in Q1 FY26 and 6.8 in Q4 26. While revenue saw a decline in AGZ due to cyclical, impact, the profitability decline was primarily due to the impact of the exceptional DMP received in the previous quarter, reflecting the lumpy nature of this revenue. If I give you some numbers for comparison, if I look at FY25, 24 and 26, the revenue on consolidated basis was 175 in 24, 145 in 25 and 190 in 26, so revenue grew. The EBITDA was 57 in FY24, 139 in 25 and 121 in 26. The reason between 24 and 25 was basically we put up 250 beds and also launched AGZ. But as you can see now, as the revenue is increasing, the EBITDA losses are now coming down. So this is a demonstration of our commitment to work towards profitability. As of June 30th, 2026, the treasury assets in Max India level stood at about 21 crores with a consolidated net worth of 372 crores. Now coming to residences, starting with Dehradun, the operations continue to be profitable. We continue to focus on deeper engagement with our residents, cost optimization and profitability. Operating revenue was 6.2 crores in Q1 FY27, which is 1.1 times Y-on-Y basis. Marginally down by 7 lakhs, primarily due to club membership, but these are all cyclical things will catch up. But our operations profit was a shade better, 0.92, which is up 2.3 times Y-on-Y and 1.2 times Q-on-Q, driven by continued cost optimization. There were 4 units which were released, which gave us additional revenue approximately 1.9 crores in marketing fee. And the community is now fully occupied, quite stable. Therefore, the growth will be linear in the future. Coming to Gurgaon, which was the first intergenerational project in Gurgaon Estate 360 developed by Max Estate, fully sold out. Collection continues to be strong, 22.5 crores, taking the ITD collection to 556 crores with a collection efficiency of 87% from inception till June 26. And Antara has earned 47.69 crores of management fee till 30th June 26, out of which 3 crores have accrued in the current quarter. The second intergenerational project, 361, which we only launched, if you recall, in December, total 360 units. We launched 180 first and then 180 in June. As of June end, the bookings were 154. So April, May, June, the market was sluggish given the geopolitical situation, but it is now caught up. So while we sold only 27 units in Q1 FY27, in the month of July alone, we sold about 34 units, and a similar trend continues in August. So we have caught up. The market is, getting back to a little bit of normalcy, and therefore the sales velocity has now totally caught up on that side. Total collections 108.2 crores since inception. So about 194, 197 units, sold so far. On the Antara assisted care side, total bed capacity of 485 beds across 8 care homes in NCR, Bengaluru and Chennai. We have now completed and relaunched the DLF Phase 2 Gurgaon Center in July 26, and all the 8 centers are now operational. Happy to report that 5 out of the 8 care homes are trending as per the operating model, and we are confident that others will also follow the trend. and we'll continue to watch this progress very carefully. The care home and services revenues were 12.03 crores, up by 1.5x Y-on-Y and 1.1x in Q-on-Q. The care homes revenue on a standalone basis was 1.3x in Q-on-Q, and the OBDs, the occupied bed days, went up by 23% on a Q-on-Q basis. Many care homes, as I said, are showing very good trends. The occupancy, Bannerghatta, Bangalore, 41% in Q1 FY27, up from 37% in Q4 FY26. Gurugram, 41% from 33% in Q4 FY26. Whitefield, Bangalore, 18% from 8%. And OMR, Chennai, 12% versus 3% for the same period. So you can now see how the occupancy is increasing across the care homes. Our care homes and services have now served about 2,700 patients during Q1 FY27 and about 53,000 patients in inception. Revenue in the segment rose to 12.03 crores, which is 1.5, as I said earlier, on Y-on-Y basis and 1.1 on Q-on-Q basis. The voice of customer, a steady 84% in Q1 FY27, remains stable in July as well, reflecting the consistent quality of care and service we are delivering. Happy to also report that 4 of our care homes achieved an ever highest ARPOB, which is average revenue per occupied bed day, of 7,000 rupees plus in June 2026. This is really a testimony that the customers are appreciating our quality service at a higher cost. 3 of the 4 care homes have shown significant improvement in contribution margins, which now reflects the past profitability. On AGZ, we received a net revenue of 19 crores in Q1 FY27, showing a 1.3x Y-on-Y growth. It was lower than Q-on-Q of 23 crores, driven basically by moderation of demand beyond the Q4 peak demand period. As all of us know, March quarter is always high from a revenue perspective to cover the annual targets, but some of this will get caught up as we go on in the year. The ARR now is trending towards 120 and a monthly run rate of about 10 crores in July, with marketplaces 6 crores, the ROAS of 3.8, and a D2C, the exit ROAS of 2.6. So you can see from the numbers that now we are catching up on the ROAS as well. The offline channel achieved its highest ever revenue of 5 crores, growing 18% Q-on-Q basis, a very good response to the newly launched product Commode Wheelchair. The overall ROAS, which is return on ad spend in Q1 FY27 exit, has improved to 2 versus 1.8 in Q4, marking a 10% growth. The SAT index in Q1 FY27 is 82%. AGZ now has 112 products launched till date, out of which 86 are currently live. We are now also present on quick commerce, which is Blinkit and Zepto. Our diaper category, which was the new unique diaper that we had launched, which we have a patent on, now we are hitting a 1,500 pack sale per day, which is really, a 6x growth in market share on Amazon over the last 60 days. As you know, this is a unique product. It is the only adult diaper with the smart absorption technology, and now it is showing up in our increasing market share as well. 4 patents have been granted to us for products, and there are 3 patents which have been filed for senior specific innovative products, reflecting our commitment to innovation. And this really will be the biggest differentiator and the moat that we will have. The more patents we have, the more stronger our products will be differentiated. AGZ so far has touched about 9 lakh lives with about 88,000 repeat customers, and served since inception achieved an NPS of about 60, which is quite high, but that reflects improving customer stickiness as your usage deepens over time. Gross margins for online channels, which is D2C and marketplaces, maintained at 45% in Q1 versus 46%, despite very challenging geopolitical situations which have pushed up the COGS for each product. From this quarter, we are over-indexing on brand awareness. We have onboarded Anupam Kher as our brand ambassador, and therefore we did spend some money, which we'll see as an expense, in the financials submitted to you. But we are seeing the payback as well. In the month of July, the ARR has now picked up to about 10 crores. Our conversion rates have improved from 2 to 3.5, and our ROAS has gone up as well. So the brand spend that we did is already showing a payback in the month of July itself. If I was to really, consolidate, ASCS, and look at Q1 last year, Q4 and Q1 this year, the revenue was 21, 32 and 30 respectively, with EBITDA losses at 14, 18.5 and 19. So despite the brand spend, despite the cost of goods going up, we've been able to bring down the EBITDA losses or keep them flat with revenue, going up quarter on quarter. The last update I'd like to give you is on the Antara Integrated Wellness Clinic. As you know, this is our key differentiator for residences. We had launched a pilot in Gurgaon in our care homes to see what is the impact and what is the receptivity of customers. This is a wellness clinic anchored around modern medicine, but combines modalities of Ayurveda, ozone therapy, infrared sauna, nutrition, etc. Financially, the net revenue for Q1 FY27 was 15.75 lakhs. This is expected at this stage to be a negative contribution margin. This is the first quarter only, but we should be able to cover it up as we go forward. On the customer sat score, very high, satisfaction 96%, with average revenue per client of 4,000. The footfalls have grown steadily from 199 sessions to 307 sessions in June. It's a rapid increase. And therefore, we'll now focus on, spending some marketing monies and scaling up this, and also making sure we launch this in Antara Noida as the residents start checking in. On the partnership front, we continue to work with Star Union Daiichi Life Insurance to integrate senior wellness with financial literacy, culminating in specialized financial products for seniors, and with IIT Delhi on mobility products and well-being nutrition on nutraceuticals and supplements, and Swasa on self-diagnosis for lung health. Our brand continues to gain strong recognition, with Antara Senior Care receiving the Visionary Leadership in Senior Living Award at the HT India Real Estate Expo in June 26, honoring our contribution to India's silver economy. We also concluded the NABH accreditation in Bannerghatta, which is quite essential for TPN insurance. And we have gone through some more inspections for NABH and the other care homes. So in summary, Q1 FY27 has been full of action and execution. We remain confident in our underlying trajectory, backed by successful handover of possession at Antara Noida, steady sales momentum in Gurgaon now, and improving occupancy trends in care homes and early signs of recovery in the Age Easy ROAS. As we look ahead, we remain committed to profitability. As we said, Age Easy, perhaps, by January or last quarter this year, will be in that zone. And we'll continue to contain losses even though we scale up, care homes to make sure we are committed to our path to profitability. So I'll stop here and welcome any questions that you might have. And thank you once again for joining the call.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Harsh from Ionis Alpha. Please proceed.
Yeah, hi. Hi, Rajat and team. Couple of questions from my end. Firstly, a broader question. Just wanted to double-click on the EBITDA, break-even by the end of the financial year target. If we could just, understand, particularly from the cost angle, what should change, in this quarter versus, say, Q4 of, this financial year. And even, from a top-line basis, where should one look at? I understand the resi business can be quite lumpy, but just talking about Age Easy and care homes, what should that look at, broadly speaking, by the end of the financial year? Secondly, on the care homes part, just wanted to understand, your thought process as to where do we stand now versus, what was the initial plan, especially on the occupancy levels. Reason why I'm asking this is that, is there any plans to start adding beds in near future? Have we reached that inflection point?
Yeah. So as I cannot comment on specific numbers of FY27 in the future, but when I made the comment on profitability, I meant on AGZ, which is our commitment. That is one. Care homes are obviously, since we built out the bed in the last 12 months, they will have to wait out the 8-10 quarters it takes for the bed to be profitable, at a unit level. ASL will continue to be lumpy, so when we get the DMP and etc., it will show as a bit up, positive, right? But that varies depending on the projects we sign in DMP, right? But to your question, I'll repeat the numbers, once again, so that you're able to see what I'm saying. If you look at our overall consolidated basis, the revenue has steadily gone up from 175 to 145 to 190 over the last 3 years. The EBITDA losses were 57, went up to 139 because we added 250 beds, launched AGZ in that year, and then brought 139 down to 121 despite the revenue going up. This trajectory will continue for FY27 in terms of revenue going up substantially and the EBITDA losses getting contained, because now we are not adding any new beds at this point of time. AGZ will continue to throw better contribution margins. So as we go in the next quarter, you'll find this trajectory to be substantiated. Occupancy, as I said, the OBD beds have gone up by 23%. But if you look at respective, care homes, Bannerghatta is from 41%, from 37 gone up to 41%. Gurgaon from 33 to 41, Whitefield, Bangalore from 8 to 18, and OMR from 3 to 12. So 5 of the 8 care homes are now trending to the model that we have shared with all of you, respectively. 5 of them, right? The rest is work to do as we go along, but now we are confident. So sometime, the inflection point, if you recall, was October, November. We had said we'll wait till that time and then start making the call on expansion. So we are sticking to that timeline. No changes in that, as well.
Just to add, Harsh, on AGZ, what are the metrics that you would look at and how that will move to profitability is your CM2. If you see historically, we've reported -80, -70% CM2s for AGZ. As of July, the marketplace's CM2 came down to -17%, 17%, and this number for all other channels will continue to improve at the back of improving return on advertising spend, which Rajat earlier. And this will be corresponding to better gross margins and higher top line. So that is how the CM2 will keep improving to achieving a break-even till Q4.
Some of the aberration you see in, for example, employee expenses, right, is basically some provisions getting written back. So each year we provide for variable pay, but when we pay out the month of May, for Q4, the provisions get trued up, actualized. But once we start Q1, we again start providing. So it's just an accounting thing in terms of provisions, nothing else.
Understood. Just on the blended ARPOB bit in care homes, I understand that the last few bed additions or substantial bed additions were at a higher ARPOB. So ARPOB should be between a blended ARPOB, once the occupancy rises, should be between 6,500 to 7,000. Is that the right way to look at it?
Should be near 7.5, Harsh.
Okay, understood. Thank you.
Thank you, Harsh.
Thank you. Before we proceed, a reminder to the participants, in order to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Nikhil Gupta from Vayu Capital. Please proceed.
Good morning. Thank you for the opportunity. My first question is a bookkeeping question on senior living. So out of the 33 odd crores collection we did from the Noida community, what would be the revenue which would have been attributed to the Q1?
So the revenue in the Noida will be booked at the SPV level, and since it's a joint venture with us, so we will be only consolidating the net P&L. Now, as regards the joint venture company, if you're asking about the revenue recognition there, presently in June, there had been no revenue recognition because the revenue recognition is not linked with collection. It is linked with the possession or registration. So the possessions are going to happen in Q2, and that's the year when all the revenue recognitions and inventory write-offs will take place.
Thank you, Ajay, for that answer, but somehow I'm not able to reconcile the numbers. So let's say, so you have mentioned in the investor deck the odd 38 crore from that senior living segment. I believe around 8 crore is the treasury income and 30 is our core operation. So around 6 is Dehradun, 3 and 4 is from our Gurgaon communities. I'm not able to add that 30 number. Can you please help me with that?
Sorry, from where are you seeing this number? From the results?
Yeah.
So, from the results or from the investor deck?
Both. I mean, it's they are same only, right?
Residential have three components of income, sir. One is the DMP's income, what we are getting at Antara Senior. Second is the ops revenue, what I am getting at Antara Purukul. And third is the finance lease income, which I am getting as a release in Antara Purukul. That amount was approximately 15 crores for the quarter. I think that's the gap what you are mentioning at that way. Since it's not a regular income for me, it's always an exceptional because we don't plan for a release. Hence, I don't explicitly display this into my gross revenues in my investor release. I just simply say how much release we have done and how much marketing fee I want.
Okay, so the DM fees is around 7 crores, operation is also around 6-7 crores, and the finance lease is 15.
Correct.
And what would be the then odd 8 crores? That would be the treasury income at the residential level?
Correct.
Okay. Can you help me explain this finance lease? What is this income like? I'm not able to understand this.
So basically, our Antara Purukul is on a lease model, wherein if any units get resold, so if somebody is exiting because of death or they are shifting from Delhi, shifting from Dehradun and they want to sell their property, it has to be released. So they have to surrender their lease to the company and the company have to release it again. So as per accounting standards, the remaining lease period I have to recognize as a revenue, and against that I recognize the cost, the lease premium, and in that particular transaction we earn some bit of a marketing fee that I account for as a additional revenue in our other income.
Got it. My next question is on our integrated wellness. So going forward 3 to 5 years, do you see this segment growing significant, contributing significant to our P&L? Because in the annual report also, I think we have mentioned this category as a separate segment. So can you provide more color that do we think that it can contribute significantly going forward next 3 to 5 years?
See, the ARWC is an integral part of our residences. We are not opening a separate business line where we will launch ARWC clinics. We will simply put them in all the residences so that it's a strong differentiator, very difficult to replicate. It is not just about a doctor or nurse sitting in the campus. It's about a full-fledged protocol-based integrated medicine system which we are launching in the residences, and therefore all the revenues which come from there, right? Difficult to predict at this point of time, but given the volume of people we are handling, let's say 340 people units in Noida phase 1 means about 600 people, right? Difficult for me to comment, how much revenue we will get, but it's a strong differentiator. We will also try to put them in the care homes to be able to work as OPDs to attract, footfalls, right? So that's the intention really. We are not launching standalone clinics.
Right. Well understood. The last question is on AGZ. I think somehow the growth has been slow, but sometimes that happens, that's fine. I think we projected to almost double our revenue from 77 to 150 odd crores. So do you still see that happening? Because somehow we are still at the 18 crore Q1 revenue seems very, very low.
Yeah.
Some thoughts please on that.
Hi, Ishan here. Yes, we are still very much on a plan for doubling this year. If you see the year-on-year growth, it is still significantly high. Yes, quarter-on-quarter, there has been moderation. But if you look at July numbers, which Rajat quoted, we are already at a 120 crore annual revenue run rate with a 10 crore closing number for the month of July, which is not only an improvement in the top line, but is also complemented with a significant improvement in return on advertising spends. Which is what we were working on in quarter one to solve, so that the next 3 quarters of growth is at the back of a strong base, both in terms of our CM2s and our ROAS. So Q2 to Q4, we will see a significant improvement in the top line, as now we have already demonstrated that we can efficiently do it by improving the ROAS.
Thank you for the response. That's it from my side. Best of luck.
Yes.
Thank you.
Thank you. Before we proceed, a reminder to the participants, in order to ask a question, you may press star and one on your touchtone telephone. We take the next question from the line of Ranodeep from MAS Capital. Please proceed.
Yeah, thank you for the opportunity. My question is around AGV. Now, AGV's revenue has declined 18% QOQ after the Q4 peak. Now, how much of Q4 was genuinely seasonal versus demand pulled forward through promotions? And what should investors consider, the normalized quarterly revenue base going forward? And a connected part to the same AGV is like we've touched 9 lives till date, but only 88,000 are repeat customers. So how do you distinguish between top line growth purchased through marketing and genuine customer loyalty? And and the last part to that question is, what repeat rate and CAC to LTV ratio would convince you that AGG has become a structurally strong consumer brand?
Yeah.
Sure.
So I'll let Ishan answer that. But to your question on quarter-on-quarter, there was a transition that we're doing, in Q4 last year, right, which causes aberration. But let Ishan explain that.
So I think the one has to be cognizant of a couple of things in a business like AGV, which is a products business, is that one, there will be 2 impacts that we will see on how this plays through the year. One is that around the festive period, which is depending when it happens, September, October, we will see a significant surge, which we saw last year as well. Q3 was a significantly higher number compared to Q2, or September, October was the peak. We will see that same peak this year as well. And the second seasonality impact that comes, which does come for products like kneecaps, nebulizers, diapers, is during the winter season, where the consumption is higher. So going forward also, I would want to indicate that we will see these, it will not be linear. We will have these spurts during periods of either high purchase during the festive time and then in the winter season. What also happens towards the latter half of the year is that we do, and because we work with marketplaces, there are some big deals, that purchases that they make from us, because it's everybody's year-end and closing. So that also happens. And hence you see that kind of an impact. Will we see that this year? Yes, we will see that kind of seasonality impact and festive year impact this year as well. Like I also mentioned, that July and August, we are already seeing that is going back to 120 and now 140, 150 crore ARR as well. So that trajectory is picking up, giving us the confidence that the guidance we have for this year's revenue for AGG should certainly happen.
And on the CAC to LTV ratio?
We will currently be looking at return on advertising spend. The return on advertising spend is a critical factor because that currently tells us the efficiency that the brand is giving us and how our performance marketing is efficiently moving. We were at, if you recall, in the last quarters, we were at around 1.5 for our D2C, and we were at around 2.5 for marketplaces, which is now closer to 4 for marketplaces and 2.5 for D2C. Now that efficiency indicates that because marketing is the biggest spend in D2C, in AGG, so that return on advertising spend is a critical factor. And on your repeat, I want to clarify one thing, that our repeats are not 18,000. Our repeats are around 88 to 90,000. That's the number. We are at around 10 to 12% repeat rate. One has to also understand the nature of products we sell. Besides diapers, which is one of our top selling products, the others don't lend themselves to repeat. So somebody who's bought from us one product will at best buy some other product. And chances of buying the same product, like if you bought a BP monitor, you will probably come back and buy a BP monitor from me maybe after a year or two. So same product repeats are lesser. The cross sell is where the opportunity is, and that's what now we're building an engine to promote and push.
But directionally, if you're able to achieve a 20% plus repeat rate, we should be in good space.
Sure. Thanks for that clarification. Rajitha, my next question is more of a macro question and to you. So Max India's long-term thesis appears to be built around India's aging population and the emergence of large silver economy, which we've explained beautifully in the past. But given the significant capital requirement to build communities, care homes, and consumer products, what prevents a large hospital chain or a real estate developer or a financial services player from eventually entering senior care and compressing your returns? What is the moat you believe will still exist 10 years from now?
Yeah. So let's talk about a segment separately, right? And by the way, please keep in mind when we are saying we are building an integrated care ecosystem, we are focusing on the consumer. It's the same consumer who, depending on age, medical condition and circumstances, will need either a residence or a rehab or a diaper or a wheelchair. So we've taken a customer view, number one. Number two, if you look at all the three segments, real estate players can come and replicate the infrastructure, no doubt on that, and maybe do a better job. However, the core of that product is services, not infrastructure. It is all the IP we have gained over the years in terms of what kind of engagement services, what kind of wellness services to integrate, what kind of mental wellness, emotional, social, etc. we'll have to offer. All the practices that we have picked up in terms of how to handle muscle loss, frailty, anxiety, depression, and now our ability to put integrated medicine inside, which is more IP based. It's not just hire a doctor and start doing that, which is going to be a strong differentiator. Most real estate developers, if you follow the trend, are outsourcing this. Either they are tying up with a nearby nursing home or tying up with a hospital, right? That's not a sustainable model. You need a doctor to stay on the campus. You need a first responder team for emergencies. You need nurses 24/7, so on and so forth. So from that, our moat is going to be our entire IP around wellness services, right, that we have developed, which we will now keep on, strengthening as we go along. That's on that. On the care home side, frankly, there are some hospitals, chains who are doing geriatric, care now wanting to do care homes. The simple answer I have is, if I was an investor, since I come from the healthcare world, I'll prefer to spend 100 rupees on the healthcare business that generates a EBITDA of 30% plus versus an 18% margin. The care homes are more a hospitality with some medical care kind of business, while the hospitals are more surgery, diagnostic, and pharmacy business. So while they in a summary sense somewhere appear similar, the profit signatures and the competencies are very different. So if a hospital decides to come into the care homes, frankly, the investor should ask the question, why the hell are you diluting your margins? Why are you spending your time and money? Right? Either you say that you are running your hospitals totally full, you can't open more beds, and all the flow over you want to capture. Right? If you look at the care at home journey as well, many people are offering at home services, but they're only offering to the captive patients. They are not able to market and find profitability. So that's my answer to the second question. On AGC, there are only two modes, which is differentiated, innovated products which are senior specific and brand. Nothing else is a mode, right? So therefore, the patents we are filing, we already have, 3 patents, 3 we have filed. The more we learn about, consumer behavior and the bigger brand we build is what's going to stand us, in good stead. The market, by the way, individually for the products is quite large. If you look at the diaper market itself, it's about 2,000, 2,500 crores kind of market, or 5,000 crores only, right? So we are not building a 10,000 crore business in AGZ in the next 5 years. It's going to be perhaps 1,000 crores. So enough market to be had on that side. That's my answer to the verticals.
Appreciate the response, sir. Only just from a, I think we raised it last time also, I think with respect to the announcement about expansion, if we can be a little more aggressive, given in the past you've seen couple of cities being on pause or halted, So we eagerly look forward to the announcement, and I think you gave a glimpse about the Bangalore opportunity that you spoke, so look forward to that. Yeah.
Absolutely. I'm quite unfortunate we had to unwind Chandigarh because after Operations Sindoor, the height clearances were not given to communities on the flight path. And Bangalore, unfortunately, the developer ran into some financial issues, but totally appreciate that comment. Quite focused, and in the next few months, you'll find the announcements coming through.
Thank you.
Thank you. We take the next question from the line of Rajveer Singh from Vivek Investment Managers. Please proceed.
Hi, thanks for the opportunity. My question is that among the residential senior living, care homes, care at home, and AGV, which business do you believe can ultimately generate the highest return on capital? And where do you intend to deploy the majority of incremental capital? That's my first question.
Okay. So by nature, if you look at the way we do our business, our senior living model is quite capital light because we don't buy land. We tie up with developer partners who own land and preferably construct. So there we don't require that much of capital per project. It's very small. AGZ, we have already done the heavy lifting and the investments. So if you're able to meet our objective of FY27 last quarter being contribution positive and EBITDA positive, that will not require much capital. I think the capital will be required will be care home expansion, because each bed takes about 10 to 12 lakhs per bed, including the ops losses. And therefore, that's going to be a business of scale. That is where most capital will go.
So do you think the highest, that business is also going to generate the highest return on capital as well? If you are deploying so much of capital there instead of in the other areas?
You see, if you look at, you're talking about ROCE, I presume.
Yeah.
Right?
Correct.
There I feel, AGZ, obviously the nature of the business is such as e-commerce is not linear in growth, it jumps in terms of, the ARR. That is going to be the highest ROCE business, followed by care homes. The ASL segment is quite IRR based. And there our objective is to be able to build a very healthy annuity income. So if we are able to achieve our target of 1,800 crore sale value every year, we will be able to see a very healthy annuity income in 30 and 33. So the three businesses operate a little bit differently, but between AGZ and care homes, obviously AGZ will have a much higher ROCE. But even the ROCE in care homes should be 23, 24 plus.
Understood. My second question is that despite strong revenue growth, the company is still reporting substantial losses. So can you give us a sense of the expected cash burn over FY27 and 28 before the existing businesses become self-sustaining?
See, I can't share projections of 27 and 28 at this point of time. I only shared the past numbers with you. As I said, the EBITDA losses went up from 57 to 139 when we built 250 beds and we launched the AGZ business. But since then, the revenues increased and the EBITDA losses have come down, from a 95% to 63% this year, right? EBITDA loss. A significant drop suddenly. And this trajectory will continue in FY27. As we report next quarter, I promise you will see the reduction in 63 as well.
Okay. Thank you so much for answering my questions.
Okay.
Thank you. A reminder to the participants, in order to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Vikas, an individual investor. Please proceed.
Hi, sir. Thanks for your time. Just wanted to understand, since you're making a decent amount of losses still, and we have raised capital last year, and the cash is also limited on the balance sheet, how we look to sustain the business going forward? What kind of capital raising plan we have?
So nothing has changed because from what you said, a year back, 2 years back, in terms of how much capital we need. The first raise was done through 2 tranches of rights issue and the pref issue. And the balance was supposed to be raised as we went into business. That was supposed to be done June this year, but frankly, due to better performance and we taking some credit lines to manage the working capital, inventory, etc., we have been able to push the second fund raise out, but the number hasn't changed, right?
And then the 40 crores we received in July.
And we've also received 40 crores as the second tranche of the pref issue in July. What has changed really, this caused us to have a, push the fundraise also is that the Noida possession, opened up, and therefore those collections have come in, and we're able to utilize that. But the total number of capital required has not changed for the last 2 years. In fact, it's come down a shade. From a peak requirement, which we thought was about $25 million, it's come down to about 20 or under 20 now.
So let's say for next 2 years, what is the incremental capital required, sir, as per our thought process?
The estimate is around 20 million.
Okay. Thank you.
Okay.
Thank you. We take the next question from the line of Rajveer Singh from Vivek Investment Managers. Please proceed.
Thanks for the follow-up. My question is regarding DLF announcing its entry into the senior living. So I just wanted to know your thoughts about it. I mean, it's a big competition coming in.
Yes, surely. It's not only DLF, it's other also marquee investors wanting to look at senior living. DLF, our best understanding, though they have delayed their launch consistently for last 6 months now, is they have an existing community in Gurgaon where they are putting 1 or 2 towers as senior living. It's not something that they're creating new. Within the existing township is what they want to do. And they're tied up with most probably Medanta Hospital for doing the healthcare services, how they're attempting it. We welcome the move actually, because all these people will spend marketing monies and create awareness, for the customers. While the announcement made by DLF came 6 months back, we haven't noticed any impact on our sales velocity of Gurgaon. It is going as per plan for this year. We are exactly on the plan. But I think we are actually wanting more and more people to step in. A, it increases category awareness. B, it will also push the government to release minimum standards. Because the more standards that come in, some of us who are specialized in senior living will tend to benefit. So actually we are quite welcoming the move.
Yeah, I think as first it should give us the first mover advantage as well.
Yeah, it's already.
Yes, thanks.
We haven't stopped our sales in 361. And as I said, the launch has been delayed twice now. So let's see when they launch.
All right. Sounds good. Thank you so much.
Thank you. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments.
So thank you very much once again for joining. Again, deeply appreciate the questions. I think you're absolutely on the ball. These are questions you should be asking us, on the path to profitability, on growth, and making appropriate announcements. We absolutely welcome these. I'd like to assure you that whatever plans we had for this year were currently on plan. As some minor, aberrations because of external factors will keep on happening. For example, the labor codes pushed up the manpower cost for the quarter. Now we'll have to find ways and means of mitigating that. The geopolitical issue, caused the logistics cost, and delivery from China impacted. And we had to airlift some products which caused a margin depression. But all these in the current world are things I think any business should just embrace and keep moving on. And that's what we're doing. We're just focused on execution. There is no new strategy we have to think through. We are very clear what we are doing and what we want to do. Hopefully in the next 2 quarters, you will find more and more evidence from us on our commitment to path to profitability in all the businesses. There are different points of time, but at least the movement you should be able to see. That's our promise to all of you. So thank you once again, and wishing you a very, very happy 80th Independence Day as well.
Thank you. On behalf of Max India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.